Hi, I'm Steve Van Metre, and welcome to your weekly economic update, where we take about 30 minutes on every Friday to take a deeper dive into the markets. Of course, after Wednesday's deep dive to catch up from Friday's audio mistake and Monday's holiday, I don't know if we'll go 30 minutes, but we'll find out. So, news last night, you probably heard that President Trump has announced that effective June 10th, that we will institute a 5% tariff on all imported goods from Mexico that will increase by 5% the first of every month and cap out at 25% until they deal with the immigration issue. Now, I believe the president of Mexico or somebody from his task force or team or delegation or whomever has boarded an airplane that's headed to Washington, D.C. over the weekend to try to make this not happen. Now, what was interesting, the market's take on it, there was an initial reaction. This is a computer models that literally read the news. And you're like, well, that's not possible. Well, let me tell you what, unless you knew this announcement was coming, and nobody did, you had all your trades lined up to sell, and you could read really fast and push the sell button within about 3 seconds, which you can't do. It's computer controlled. These are the computers that read the news and react. So they sold the market down last night, and then Asian markets open, and then by the Europe Open, things had gone down. But U.S. investors don't care about the news. They have become so accustomed to the Fed saving them, to stocks going up, that every time stock prices fall, they buy, and they buy, and they buy. And you can tell when the tide is changing, when the markets drop, buyers come in and bid it back up, the next day it drops. They bid it back up, it drops. They bid it back up, and it drops. At some point, they run out of money to bid it back up. And that's when the bottom comes out. So as we watch over the last couple of weeks, we see this again, bidding price up, overnight low. Bid price back up, overnight down. They're kind of at the end of the cycle because the money supply is not growing enough to provide a bunch of money for everybody to prop the market up. And with the Fed still tightening, yes, even though they're not raising the federal funds rate, they are still doing quantitative tightening. They're still unwinding about $35 billion per month of their bond portfolio. That is pulling liquidity out of the economy. Now, the investors' answer to the Trump tariffs were, he doesn't mean it. It's just a bluff. He's just trying to get Mexico to jump and deal with this problem. I would think by now that people would realize that he's not playing around. He's not. If he says he's going to put a tariff on and he feels there's going to be a need, he's probably going to do it. And anyone who thinks that he's bluffing, well, he likes that too, because the more people that think he's bluffing, the more likely he is going to do it. So at the moment, we are 10 days away from tariffs on Mexico. And as of tomorrow, there are tariffs going in effect on U.S. imports into China on about $60 billion worth of goods. I don't remember how much they're tariffing us on that. I don't recall. I just now know it is going into effect tomorrow. So all that to say is the stock market in late trading finally said, hey, you know what? All you people that wanted to buy, this isn't the time. This deal is serious. This is going to put the new USMCA, which is NAFTA 2.0, in jeopardy. And that is obviously because the USMCA has not been passed, has not gone through Congress, has not passed, is not law. And now everyone's thinking that's going to go, and that Mexico is going to respond. And they have said, if this is true, and we don't think this is going to help the immigration problem, well, we will respond. And of course, we also heard in overnight trading that China was going to potentially escalate their tariffs if things didn't change. So there you have it. The market doesn't like tariffs because it creates uncertainty. Now think of this. So say you've got a factory over in China. So you're a business, you have a factory over in China. These tariff things are going on. You're looking out in the future and thinking, this could be bad for business. So I'll relocate my factory. So you start calling down into Mexico and say, hey, I'd like to think about relocating my factory. And bam, you just find out today there's tariffs. What do you do as a business owner? How do you handle that? Well, it creates a lot of uncertainty. And businesses don't like uncertainty, so they tend to kind of just, close down because they're not sure where to go. Where do you go next? Do you go to Canada? Do you go somewhere else? Are there going to be tariffs there? You don't know. And again, markets don't like uncertainty, but retail investors seem to like every drop in stock prices. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Been expressed in this video that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So all that to say, anybody who thinks that this is getting better, no. This is only progressively going to get worse because there's no deal with China. There isn't. And I don't think Mexico can stop things fast enough. And in fact, based on what I read that they had to say, they don't think this is going to do anything. But there you go. More tariffs are coming. But this is a really sneaky way for President Trump to get money for his wall. Now, I know he said that Mexico is going to pay for it. And anyone who understands tariffs understand that tariffs are a tax on a domestic consumer, or us. So when he raises tariffs by 5%, yes, we pay a 5% additional cost. That money goes into a special tariff fund in the government. It really actually does, that he could draw on to spend any way he wants. Perfect. Congress won't give him the wall he wants? He can tariff this way there. There's no doubt 5, 10, or even 15% tariffs will give him plenty of money to build as much wall as he wants, and then watch, he'll build it, and when he's done, he'll pull the tariffs down and say, thank you. But maybe not to the American public. I don't know. But that's who's going to pay for it as of right now. All right, so let's get into the charts. Oops, we're on to the money supply, and I'm pretty impressed that the money supply actually is holding flat here. Everything suggests that it's going to continue to fall, but the M2 growth increased 15 billion. Not a whole lot when you look at how much interest rates have fallen. But anyways, the 6-month rate of change is at 2.26. Double that, you're at 4.5%. So that suggests that this number is low. And you've got the 3-month rate of change. You multiply that by 4, and you've got that at about 4.5%. So again, it says the annualized rate of change is a little low, and that could tick higher. Like I said, I'm just frankly surprised there's still enough lending going on to keep the money supply growing. It's not growing much. It's only growing at 4, which is, again, very, very, very low and not enough to support current asset prices. Looking at commercial industrial lending, this is probably what's keeping the money supply held up. The growth rate is down slightly to 7.56% on an annualized basis. The year ago number dropped down to 4.62. The 6-month and 3-month rate of change still suggests that this number, the annualized number, has got to come down quite a bit, down below 6. So we'll see, but generally this trend is, if it could go up, is highly unlikely, but the trend is rolling over, and we'll see what happens with this little bit right here. Consumers who are not driving a lot of charging, they're only charging at a rate about 4.2% over last year. This is rolling over, and again, as a consumer, it gets tapped out because wages are not growing as fast as consumer prices. That means that consumers are going to spend less because they have less. Federal Reserve balance sheet dropped by $9 billion, so they went a little over their target. In fact, I noticed that, and then later that day, someone posted on Twitter, yes, the Fed went overboard, and it was because they had no choice, and apparently they're already remedying it, but it shouldn't be a problem. So they went a little over. We'll see another $35 billion coming off in June, July, August, and September before this whole thing comes to a stop. Going on to bank deposit growth, we're up to 2.15% on an annualized basis. Again, this is extremely weak historically, and it continues to suggest that consumers are not in a position to weather a recession at all. They need to be. Now, this is my only other slide in the deck today because we kind of went through most of them on Wednesday. So if you missed the Wednesday update, that's where most of the charts came from. That would be last Friday, Monday, and then Wednesday. So this is dollar volume growth, total spending from First Data Merchant Credit Card Services. So when First Data Merchant Credit Card Services shows dollar volume growth dropping, that is not a positive sign for retail sales. So it just says less money is being spent. So here we saw this big jump in March. We know because we saw it in the retail sales data. Everyone got, again, bullish on the economy's coming back. Nope. This is saying, no, the economy's not coming back. It's headed back lower. And you can see that retail sales, there's a December low in the market. Here's retail sales bottoming. And this is, suggesting that retail sales are going to head lower once again. All right, so let's jump out of that and over to the web browser. Let me close that out of the screen, and we'll get that loaded up so we're ready to go. All right, on to the Fed H.8 release. It shows the asset and liabilities of commercial banks. And from looking at bonds, Treasury bonds, the banks held on. They just dropped $1 billion in Treasury bonds. This was last week, so this is not this week. Last week, they added $3 billion of mortgage-backed securities, and then they shed $4 billion of non-mortgage-backed securities. Now, this is pretty interesting because the bond market is starting to rally, and the banks aren't really buying much anymore. Now, what does that mean? Well, it's real simple. See, the banks are part of the smart money, hence why they're smart money, because they know so much about consumers. They have your bank account, credit card account, they know everything. And so what does the smart money do? They buy up a bunch of stuff, right? Oh yeah, you don't want this, interest rates are going up, but we want some more bonds, but yes, interest rates going way, way up. Yeah, sell your bonds, thank you. Oh man, my belly is getting full here of bonds. Oh, interest rates are going down, there's no inflation. And all of a sudden, boom, those bonds that all these banks bought, well over $100 billion worth, are going up in value, and they don't have to buy it because now they're getting everyone else to do the heavy lifting. Will they come back in and buy? I don't know, but all I do know is they're looking to make a profit off of this, and there's your evidence as clear as day right in here in the report that they're really not buying a whole lot. They don't need to because the market is now doing the heavy lifting for them. Let's look at the climate prediction. I kind of want to get through this so when we get into the charts, we can just stay in the charts for the remainder. From a temperature standpoint, we see temperatures rising over the next 6 to 10 days. But here's all that really matters, precipitation. So you can see that we've got above average precipitation coming through the Midwest. And the gray zone saying there's just regular precipitation, so that it doesn't mean there's not rain. It says they're just going to get normal rain up here, except it's going to be a little dry up in the Michigan area, but that's okay. Anyways, there's going to be wet weather coming. Now on an 8 to 14 day, again, let's focus more on the rain. Again, still over the next 2 weeks, there's slightly above average rain. And why this is a big problem is because farmers, they need to plant. Now, the federal government does provide crop insurance, and there's some rules. You have to have, like let's say you're planting corn. Well, there's a drop dead date. If you don't have corn in the ground on this date, you do not qualify for crop insurance. You can plant tomorrow, but there's no insurance. And the more seed you get in the ground, the more insurance you qualify for. Now, the problem is the ground is extremely wet back there, extremely wet. It is hard to plant in wet ground. The other problem planting in wet ground, when you have hybrid crops that were designed, as I've said before, to be planted in ideal conditions, which this is not, farmers are fully aware that they are buying seed, spending their time putting seed in the ground, knowing that it is not going to germinate. I've been reading some comments about farmers out in the Midwest who are talking about what's going on, and they call this wet farming. They said, yes, we are doing it. Those of us who can get out on our land, which many of us can because it's too wet, and some of us can only wet farm like 10% of it, but we are doing what we can to get these seeds in the ground before the cutoff because we need that crop insurance. But they're telling us, at least from the people that I read, they're saying, yeah, we saw what the Department of Agriculture said about how much is being planted. They said, well, if that's true, it's not in our area. We're not seeing anywhere near the amount of planting because we can't get to the ground. It is soaked. We can't drive our tractors over it. We cannot do it without tearing it up even more. So we're planting where we can, and those windows are closing fast. Some of them have closed, and then the rest of them are closing very, very soon. So the fact that there's wet weather coming, knowing that these seeds need drier ground to grow is really not good. So in the future, we're going to see some USDA reports saying, oh, look, they've got some more planting going on. But what we're going to then look for is what's emerging. So what good's a seed in the ground if it doesn't emerge? And the farmers are already saying, look, if you know what we knew, this crop is not coming up. All right, so going on from climate prediction, well, that's pretty. But that wasn't the chart I was looking to see. It somehow morphed into that. Let's see if we can refresh that. There it is, the sunspots. Why are we getting this weird weather? Because the sun is not emitting hardly any sunspots, and there it is. It's none right now, so this weather is going to continue. And we can even go look at the solar cycle progression, and you can see the number of sunspots is less than 10 per month. It is low, 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 and projected to head lower, which means there's going to be continued bad weather. This should be very good for crop prices rising, but for now, that's the story on that. Let's take a look at the NASDAQ McClellan Summation Index, which is a running total of the McClellan oscillator tied to the NASDAQ index. And as we talked about, when it breaks 100, it is at minus 171 right now, that bad things start to happen, meaning stocks start to just sell off. Liquidity is lost. And you can see it started at a very high point, is coming down. And based on today's price action, which this does not include, this should drop even more. The more it drops, the bigger the market's going to fall. If it breaks down below this December lows, it's going to set up a huge buying opportunity, but stocks have a long, long ways to go down. So we'll continue to update that. We'll look at that on Monday and, of course, on Wednesday as well. All right, on to the Wyckoff charts. If you missed this, I talked about this on Wednesday, and we looked at this chart here of the S&P 500, and we said, wow, look at that. It looks really convincing. And if you don't believe me, here is the S&P 500, and you can see they look really similar. Let's see if I can shrink this down enough. I don't know if this is going to work. And you get that definitely is, whatever that did is not what I wanted. Okay, well, we'll just do it the old-fashioned way. So anyways, markets rise up, they take a drop, make usually a lower high, come back down, make a higher high, come back down, higher high, go through this kind of seesaw pattern here, and then a plunge. So this is Wyckoff. He is he's not alive, but he was one of the original technical analysts who kind of watched market patterns. And look at what we've got here. A high, a lower high, a higher high, and a higher high. And he says that this move right here, or this move, let's start with this move. This move right here is a distribution move. This is where the smart money, the big players, are dumping stocks. And then all of a sudden they'll come back down here, they'll buy some of them back, get this thing rallying, and then they'll let everyone else, the retail public, institutional investors, hedge fund managers, speculators, anybody who likes to chase the market, chase it up, and then they start selling again. And now let's look. We have a down move, an up move, a down move, an up move. It's hard to see there, and a down move. So what are we seeing where we're at right now? Well, we would be right here. So we're following this this peak here. See the seesaw, and what this is saying is there's going to be a down move after it reaches that former or the second all-time high. So let's go look and see where the second all-time high is here. So obviously we're not trading quite that range. We're trading in between here. Now, what do I think is going to happen? This will be my prediction. Predictions are fun because if you're right, you can act like you're really smart. And if you're wrong, you can just say, well, of course, it's just a prediction. I was wrong. I'm wrong half the time. I think what's going to happen next week is prices are going to fall down to the support level of 735 or thereabouts. And you can see it's a good support level because prices have found support here previously, including right here. And what's going to happen is people are going to come in and buy, and the big players are going to let them buy. It's going to come back up to about the 200-day moving average where it's going to get rejected. And then what we should see from there is, if I can get my screen right, this move down right here. We should start to see the down move come. That's what we ought to see. Now, let's look at 10-year Treasury yields. Do you need any more convincing this is a topping pattern? I've been saying this for a long time, that don't worry, this is a big topping pattern. Interest rates are headed lower. Bond prices are headed higher. And look here, I don't know if you need any more convincing, but if you take 3.248 minus 2.142 current yield divide that. Oops, let's put a plus minus sign. Divide that by 3.248. It tells us yields have dropped over 31%. I would say that that's pretty convincing in my book that this is a topping pattern. Now let's look at where it's headed. We can see when we zoom out that yields are sitting right here at this resistance or support level right here. It's not a very strong one. Could we see a reversal? Absolutely. Could yields drop down to here and we see a reversal? Yes, we can. Or could they just continue all the way down here? That they also may do. Hard to say. All we know is, yes, this is a topping pattern. And what you're looking at here is anybody who is short treasuries going back to late 2016, who is short all through here and above this lower purple line and higher, is people have all lost money. People here have lost money because they had to pay the interest costs along the way. People here have lost money. So everyone's lost money who thinks interest rates are going higher and has bet on it. So at some point, these people are going to switch and get out of their short positions, which could cause interest rates to go way down. What's interesting is when we looked at the dumb money last week, they did not really move much. So what's happening is they're just being slowly squeezed because they're holding on to their view. And at some point, they're going to have a change in view, and that could readily set a retest of the all-time lows going back to July of 16. There's no reason it can't, because there's still so much money that is short on these bonds. Not only do you have speculators that buy futures contracts, you've got the quant CTA models that are buying bonds. They'll need to sell stocks. They're going to start selling stocks at some point. And you've got somewhere around 3 to 4 trillion in what are called risk parity portfolios, very popularly sold in variable annuity products that use volatility as a control of how much bonds or stocks to buy. Well, oddly enough, the smart money has been keeping volatility in a can, and they're driving interest rates down. It's genius, because when volatility pops, and it will, all these programs are going to take their stock holdings and start shifting them over to bonds. And that's going to push interest rates down, bond prices up. You've got a realistic shot at the all-time lows in yields. Here's my second opinion, or whatever. My second thought of what's coming is we're going to see a double bottom in bond yields, and everybody's going to go crazy shorting bonds, and the smart money is going to sell all their bonds to these people, and they're going to come back and buy them again after they make the same mistake twice. Let's take a look at 5-year Treasury yields. They are breaking down this upper range. So anyone who is short 5-year Treasury yields is now moving into a loss position since 2016. If they're not already there, suggesting the 5-year yields are going down to 1.8%. Where we're at right now is everything but 30-year yields are inverted against the federal funds rate. So that means, with the exception of 30-year interest rates, everything is lower than the overnight bank lending rate. That is not a positive sign for the economy. It is very unhealthy. That tells you that a big crash in the market is coming, recession is coming. It is not good. It also tells you the Fed is going to have to be forced to ease at a time where they've got no latitude to ease, due to the fact that their inflation metric came out at 1.6% and their target is 2%, and it was up from 1.5% last month. It doesn't give them much room. But look at 30-year bonds. Their yields are just crashing down. They broke through all of this support here. So maybe 10-year yields follow the same notion. So maybe 10-year has no problem breaking through here. I don't know. But 30-year yields are on a warpath to 2.5%. In fact, they're only 0.83% away from being inverted against the federal funds rate. That's it, just 0.83%. Not much, but the fact that the banks aren't selling tells you everything. When the banks start selling, then you need to perhaps make a change in plans. All right, so let's continue on. We got a lot of stuff. I want to look at a lot of charts today. Looking at trading volume was not overly high. We're not seeing liquidation here. What we're just seeing is just normal selling. Retail public not panicking again. Retail public still very bullish on stocks. They don't think anything's going to go wrong with the economy. They're hearing everyone tell them the economy's great. Trump administration, economy's great. Big banks, economy's great. Analysts, economy's great. And we're going to see a 1% second quarter GDP growth if we're lucky, maybe even worse. But nevertheless, we're not seeing big selling here on the S&P 500 at all. Looking at oil and gas producing stocks, which, as you know, and we will look at this because it's always worthwhile, they do trade alongside the S&P 500, and they're telling us the S&P 500's got to revisit its December lows. And I think the oil and gas producing stocks are going to break below there and create a very impressive buying opportunity. I just don't know what's coming first. If it's going to be the gold or oil, something is coming. Something interesting is coming here in the near future, and it's going to be a great opportunity for those who have treasuries and cash that can liquidate treasury positions back or cut them all together and deploy that into riskier assets. It's going to be a really nice play. We can also see the same dynamic here in lumber prices. Look at this. Lumber trades, as we've seen before, trades very well against the broad stock market. And lumber has broken below its December lows. It came back up and fought today, but it could not reclaim it. It literally closed at, what's the high? 5.23. Where's my bar at? This is at 5.06. So it got slightly over the very low at December, but not much. This is not a positive sign for lumber. This is lumber prices are headed lower. And if lumber prices fall, guess what's coming with stock prices? They're headed all the way down with it. Let's look at crude oil. Same dynamic as stocks. You can see how beautiful crude oil trades as the stock market. Crude oil is down to 53 a barrel, as everyone was crazy bullish. And I said, no, you want to know where crude oil is going? Follow the 5-year treasury yield. It tells you. And sure enough, crude oil is back in the support zone. And at this rate, I imagine the computer models, and I don't have an update, are starting to swing short on this. This should drive it down. I read something, someone said that to take the pressure off the economy, crude oil is going to need to get down to 20 or 30 a barrel. You've heard me say that, and that's what happens during monetary decelerations. Asset prices need to fall. Interest rates need to fall. Crude oil prices need to fall. Everything needs to fall to take pressure off the consumer. And guess what's starting to happen? The only thing that's not, stock prices. All right, sometimes I think I talk too much, but I guess that's kind of the point of this. Anyways, let's take a look at gold futures. Now, gold took up and got up here above 1,300 an ounce, getting some people excited. This is a bull market. It is not the bull market breakout yet. I think we still need to come down somewhere in here. Let me show you why. One reason is emerging markets. I said emerging markets could come back up somewhere right in here and find resistance. Why? Because look, it came down here, found buyers here, found buyers here. So the market's going to say, hey, the buyer's still here. You guys that bought over here, oh yeah, you want to buy some more? Cool. We'll let you buy. We'll see how much strength you have to bid this up, and then we'll bring it down. So again, we'd love to see a nice triple bottom here in emerging markets. Some people say this is going a lot lower. We'll see. But that triple bottom in emerging markets should correlate with gold coming somewhere down here in this 1,200 to 1,240 range. Don't know exactly, but that's where it should. The second amount of evidence that we can go look at is silver mining stocks. Now, silver miners found some support here. Why did it find support there? Well, you're going to have to use this very faint brown line, my mouse pointer, because you have to go all the way back to October of 2015 to find some people who bought here, and the market said, all right, we'll see if you're still interested. And some people are. Now, where is this going to go? Well, it could go all the way up to this purple line right here. But notice there is and I'll zoom in, a downward trending 50-day moving average. It's very rare that something comes up and blasts through a downward trending moving average. When it does, it usually reverses pretty quick. So this is not a setup for a turnaround yet. Still says silver mining prices are headed lower. Let's look at junior gold miners. Again, they popped today, just like gold did, but again, they're facing a downward trading 50-day moving average. They closed pretty much right on their 200-day. Again, their bottom is down here, not up here. So my guess is this is just, and you can see there's some nice volume here. 23 million shares traded. So we'll see what happens. My guess is with this kind of volume move and price move, we'll see an attack up to here next week. But again, this should be faded. This is not the bottom of this, not until we get a reconfirmation of this low here. And that is called buy like crazy. Looking at the big gold miners, the symbol GDX, they came up to hit their 100-day moving average in blue. Now they follow their 100-day really well. If you don't believe me, we zoom out and look, once they break their 100-day, they kind of get going. And then they kind of have trended right along their 100-day moving average. So here it is coming up. I'm assuming it's going to be rejected here. We'll see what happens early next week. But again, I'm still thinking this has got to come back down to this $18, $19 price range, but we'll see what the markets give us. I just don't think this is it. And part of that reason is the dollar, which is really one thing I wanted to talk about. And I don't have a lot of time, and I meant to do it. But here is the dollar Wyckoff chart. We're going to do it anyways. If we go a little long, we go a little long. I think this is important. So here is the Wyckoff chart for the dollar. Top, second high, and then this faded rounding thing, and then down it goes. Okay? Focus on this part right here where it chops higher, but does not make it does not break the second high over here. Now let's go to the chart, if I can get it switched over. Here's the high, which means the dollar could possibly get up here to 99 and 100. Could. Might not. We'll see. Beyond that, this rise here should then turn into a massive sell. Now, if the dollar gets up to this 100, we can go back to, say that was November 15, March 15. Keep that in mind. November, March of 15. Here we go. Where's November 15? Down here. March. Down here. So yeah, it tells us that gold mining prices can head a lot lower. I mean, it's effectively what it tells us. Let's take a quick look at the ags. Nice story here with the dollar too, because when the dollar starts to fall, these are going to skyrocket as well. Ags came up, tagged overhead resistance. Not surprised it would get rejected here. You have to assume they're going to get rejected because they got rejected once, twice, 3 times. Sellers that came in here and sold, are looking at this going, easy money, and I'll take it from you. But here what's key is watch this 100-day moving average. What do ags like? Their 100-day moving average. So I would love to see this hold early next week and then create a rally. If this thing can get some momentum here, then it's got nothing but blue skies ahead once it breaks out through the 1771 level, and then once it gets past this 1950 level, sky's the limit on the ags. So all right, so that's going to be our update for the week. Sorry for going a few minutes over. We'll be back at you Monday night to see what's going on, maybe see if there's some news, if Mexico could convince Trump to not put the tariffs on. Market ought to like that. We'll see what it brings us. I'm Steve Van Metre. Bye now.